If I were to ask you as an entrepreneur, what is one major area of concern during startup phase? I'm sure the unanimous answer would be finance. Of course, there is no doubt that finance is the lifeblood of a business venture for not only creating but also sustaining and growing the venture. However, considering the fact that most entrepreneurs typically tend to come from non-finance background, they are apprehensive as they believe that accounting is for chartered accountants. Accounting and finance are two different functions. Accounting deals with bookkeeping and preparation of financial statements, while finance deals with analysis of these statements to get a practical understanding of one's financial status. Also, since finance involves number work, entrepreneurs think that they are not qualified for this. Remember, it is not the calculation but the interpretation and implications that are important. Another myth is that finance deals with only the aspect of valuation. True, it does have to do with valuation of the firm, but it also deals with how much cash is required for the venture, where do you get this money for the venture, and in what form, borrowed or owners putting in their capital called as owner's fund. I urge you to leave behind such myth and build a successful business, the foundation of which is a strong financial understanding. While finance helps you to assess business performance in monetary terms, explains how you can plan to meet all financial obligations, and also helps you to identify areas in which interventions are required, there is more to it. Finance also helps to make predictions about the future needs of the business and estimate the financial requirements. To identify sources from where finance can be raised to accomplish your future needs. To make sure that financial resources are allocated efficiently. To measure and reassess your progress and change directions when necessary. It also helps in reporting to parties concerned. It provides the short-term basis for control and helps to prevent one of the commonest problems of a new venture. And you know what that is? Cash crunch. Let's try and understand how finance functions in an organization. Within an organization, finance functions could be broadly classified into three categories. One is record keeping and reporting, where financial accounting, we understand, is concerned with recording financial transactions in a fixed format, either as prescribed by law or by practice. Cost and management accounting provides information for use by the management for the purpose of planning and control. The second one is money management. It is the management of the firm's investments in the form of short-term and long-term investments. Management of the firm's financial structure, that is raising of money in the form of debt or equity. The third function is that of an advisory function. This function involves instituting appropriate systems and controls to ensure that the actions of managers are compatible with the goals of the business, which is maximizing the wealth of the owners of the venture. So that you understand this better, let's look at few of these terms. The terms finance and accounts are often used interchangeably, but they are two entirely different aspects of a business. While finance is related to the role of money in a business, financial management explains how this money is raised and used in the business. Knowledge of finance requires the understanding of the process of how the financial transactions are recorded, and this process is called accounting. So let's look at what accounting means. Accounting is the art of recording, classifying and summarizing the transactions that are of financial nature and interpreting the results to know about the financial health of the organization. There are few ground rules though, which are called accounting concepts and conventions that must be followed while recording the financial transactions and preparing the statements. These rules are fundamental to the science of accounting, and it is unaffected by country-specific GAAP like the USA GAAP, UK GAAP, etc. As an entrepreneur, you need to know at least few important principles. Let us understand them with the help of an example. Assume Sushil invests 5,000 Indian rupees in a restaurant called Super Bowl. The first task for an entrepreneur is to imagine his venture is a separate entity different from him, although he owns it. So, Super Bowl will owe 5,000 rupees to Sushil, which is represented as capital. The transactions have to be recorded in the financial statements from the business angle as if the business is a separate entity from that of the entrepreneur who owns and runs the business. This amount also becomes cash which Super Bowl owns. Thus, when we add something to one side, we add the same amount to the other side. This is dual aspect of accounting. Every financial transaction has two sides: asset, liability, income, expenditure, debit and credit. Let's see what a going concern concept says. As per this concept, accounting assumes that an entity will continue to operate for an indefinitely long period in the future. As per accounting period concept, accounting measures activities for a specific interval of time called the accounting period. For the purpose of reporting to outsiders, 1 year is the usual accounting period. After this initial investment in Super Bowl of 5,000 rupees by Sushil, there will be many more monetary transactions in the course of running the restaurant. Let us consider some of these transactions. Now, what will be Sushil's first expenses? Getting a license? He may have to pay rent for his building, buy furniture and spend on interiors, buy kitchen equipments. He needs supplies like groceries and others, pay salary to his staff, pay electricity bill. Remember, he may also start making sales when the restaurant starts functioning. Let us assume he also takes up to cater to supply lunch for 10 employees of a company Zen 10 with the understanding that he will be paid these bills by the company once in 15 days. Let's see how these transactions will appear in the financial statements. Some of these are items that will affect the P&L situation of the business and thus will be recorded in the income or revenue statement because it will show the result of the operations of the restaurant. Some of these transactions will be shown as the sources and uses of funds of the restaurant. Let's see how these transactions affect Super Bowl's business one by one. Take the first one. As we just discussed, Sushil started this restaurant Super Bowl with rupees 5,000. It will bring cash to the business and it will be shown as an asset on the balance sheet. And the other element will be capital of rupees 5,000 as introduced by the owner and will be a liability for the business. Let's take the second transaction. Paid for furniture and interiors for rupees 1,000 and also 1,000 for equipment. This will reduce cash balance by rupees 2,000 and also these furniture and equipment will be shown as two different assets on the balance sheet. Let's see the third transaction. Bought supplies from Country Basket for rupees 1,200 on credit. As this is bought on credit, it will be a liability for the business and on the contrary, the supplies in the form of stock will be shown as an asset under the asset column worth rupees 1,200. Let's take the fourth one. Owners used 400 rupees worth of supplier to cater to Zen 10 company, billing him for 900. This transaction is helping the Super Bowl to earn rupees 500 as profit shown under the capital on the liability side of the balance sheet. This is because the profit belongs to the owner. Moreover, this will reduce the stock by rupees 400 and will create Zen 10 as a debtor of rupees 900 as shown on the asset side. Look at the fifth transaction, paid salaries to staff worth rupees 800. It will reduce the cash balance from rupees 3000 to 2200 on the asset side of the balance sheet, and it will also reduce the profits. Did you notice that the profit is now a loss of rupees 300? The sixth transaction is talking about the depreciation that will further affect the profitability of the business. The fall in the value of the furniture and interior is by rupees 200. This will increase the loss on one hand from 300 to 500 and bring down the value of furniture and interiors by rupees 200 on the asset side. The seventh transaction is revenue earned by the restaurant by using 500 rupees worth of supplies and selling it for rupees 2000. Now, this transaction will bring a profit of rupees 1500 for the business, and thus the loss of rupees 500 will turn into rupees 1000 as profit after this transaction. Next, there is a payment made to Country Basket, who are the creditors. So, the liability will be reduced to the extent and the creditors amount will now fall to rupees 400. As the business made a payment, the cash will go out from the business for the same amount. The next transaction is about raising a bank loan worth rupees 300. Now, this is a liability to the business, and on the other hand, it is also cash coming into the business. In the next transaction, the debtor Zen 10 is paying Super Bowl rupees 600. So, this will be added to the cash balance and simultaneously the debtor's figure will be reduced by the same amount. 11th and 12th transactions are about paying rent and electricity bill of rupees 500 and rupees 300 respectively. This will reduce the cash and the profit figure for Super Bowl on both the liability side and the asset side. All the transactions that we have discussed have to be recorded in a manner that will convey meaning to the business. Hence, these financial transactions are recorded, classified and summarized and presented in 3 statements for better understanding. The income statement or the revenue statement, or also called as the profit and loss account, which shows the results of the operations during a period. The balance sheet, which is a snapshot of the financial position of the business as on a particular date. The cash flow statement, which shows the receipts and payments of cash or money made during the period. We will see what these statements mean to the entrepreneur, taking the same example in our upcoming segments.